Well, good afternoon, everybody, and thank you for joining this session on the impacts of COVID-19 in the affordable credit sector and results from our rapid response survey. My name is Carl Dayson. I am the Pro Vice Chancellor for Research Innovation at the University of Salford, and I'll be co-chairing this session with the very Reverend Dr. John Chalmers, Chair of the Carnegie UK Trust Affordable Credit Action Group. Today's webinar will present findings from a rapid response survey undertaken by the University of Salford and the Carnegie UK Trust from May the 13th to May the 27th earlier this year. We'd like to thank all those who supplied their information to us. We know that it takes time and that social lenders are busy and giving feedback in lots of places. We do truly appreciate it. Can we also add our thanks to the trade bodies of ABCOL, Scottish League of Credit Unions, NCUF and Responsible Finance, and the additional support of Fair for All Finance. The reason why this work was done and originally commissioned was that we started to think about the impact of pandemics on microcredit providers in particular, but also in the broader sense of small loan organisations. While examining the research under what happened in previous pandemics, especially in the Ebola pandemic in Africa and Zika, it was clear that financial institutions suffered both a short-term and long-term loss of activity, and this had a negative impact on their bottom line. Those organisations are still recovering and their economies are still struggling to recover after those particular pandemics. We were interested in whether the same thing was happening in the UK following the COVID-19 outbreak. At the same time, there was lots of anecdotal evidence that people were picking up about organisations that were finding it hard to lend in one shape or another. We wanted to bring that together to see what the actual evidence was and some of that is presented here today. We have lots to get through today and a very tight agenda. So I'm going to try and whistle us through here. The webinar is being recorded and will be made out afterwards, so it's there. If you have any questions throughout the presentation and panel, can you use the Q&A function at the bottom of your screen on Zoom? Please only use the chat function for comments rather than questions. At 5 p.m. there will be a Q&A session, which will be based on those questions, facilitated by Douglas White from Carnegie. The slides from today and additional data sets in the survey, which have not been included in the highlights presentation, will be emailed to attendees later this week and also published on the Carnegie UK Trust website. There'll be further comment on the data in the coming weeks from both the University of Salford and Carnegie. Firstly, we're very pleased to welcome Michael Sheen to today's webinar. Many of you will know Michael is a great supporter of affordable credit. Alongside his acting career, Michael is a philanthropist, campaigner, activist. Living where he was raised up in his hometown of Port Talbot, much of the focus of Michael's community engagement is focused in South Wales, though he continues to hold prominent international roles, including UNICEF ambassador. Michael, over to you.
Thanks very much, Carl. Thank you, Carl. Thank you, John, for chairing this. Hello to everybody. I hope everyone's doing all right. In spite of the circumstances, it is a genuine pleasure to be able to be with you today. First of all, I want to give apologies because of events that happened almost exactly a year ago now. I haven't been able to stay as connected to the work that's been going on over the last year as I would like to have been, but through the support of various people, I am clawing my way back into it. And so I would like to thank Sasha and Richard at Fair for All, Diane at Moneyline, Caroline Mason at Esme Fairburn, and Douglas John and Neil at Carnegie for all the support you gave me around this time last year, and in particular Neil for getting me up to speed again. And I would like to actually give special thanks to Carnegie. The work that you have done through the UK institution and through the trust and the Affordable Action Affordable Credit Action Group, led by John, has been a huge inspiration to me, and is really the driving force behind what I've been trying to do, and what has sort of spurred me on and kept me in the game. So I really, really want to thank Carnegie for that. The work that was going on before all of this, these extraordinary events with the pandemic hit, and the work that happened in the last year was incredibly positive. The work that Fair for All have been doing, I was part of conversations around that work and what was happening, and so it was amazing to see how that got taken on and what has been achieved already, and the kind of seismic shift, I think, that was on the way to being created, and I think still will be created in the sector, and the opportunities for people, organizations, fair and responsible credit, and the people that they serve. It's been hugely inspirational to see that, and I just want to say that first before we focus on some of the more negative aspects of the pandemic on the sector. And I suppose a big part of what I want to focus on, and that what I'll be thinking about, is lending is going to come back, and we have to be ready for when that happens. We have to have a plan, we have to have a roadmap, and we have to be positioned in the right way to deal with what's coming up the road. Now, obviously, we still don't know how the landscape is going to look, but we know certain things about it, and we know the kinds of challenges that there's going to be, and we have to be ready for that, because other people will be ready, who are going to take advantage of people and communities, in the same way as we've seen for years and years and years. And even though we've seen organizations like Bright House go down, there are still plenty of those sort of people out there, and so we really do need to be ready for what's ahead, no matter how challenging that might be. So I think it's really important to be able to think about how organizations like Carnegie, how Fair for All and others can help us with the roadmap of how to get there. So I still, in spite of everything, feel very positive about where we're heading. It may be a bumpy journey to get there, but I think where we're heading is still transformative and is going to make a massive difference to a lot of people's lives who really need it the most. So I know people have got to get away, so I don't want to take up any more time, and lots of other people have got far more interesting things to say than me, so I'll hand it back. Thank you.
Thank you, Michael. Thank you for those words of support. So I'm going to go straight into it with a short presentation by New Alexander from Carnegie and Paul Vick, who's a research fellow from CF for Community Finance Solutions at the University of Salford, who will talk us through the rapid response survey findings, and then before we move on to the other panel members. Neil, over to you.
Neil, you're muted.
If I had £1 for every time I do that. That's great. Carl, thanks for the introduction. Michael, thanks for the kind words. Paul, Vick and I will talk you through in the next 15 minutes the presentation that we have in front of you. As Carl said, the presentation will be emailed to you along with some additional data that we gathered, some of which we've not put in this presentation. We'll also produce some additional analysis from the data in the coming weeks. So I'm going to talk you through the first 2 slides, not unmuted, and Paul will take the remaining 5. So firstly, a bit of context. Warren Buffett, the so-called sage of Omaha, said after the last financial crisis that you only find out who's been swimming naked when the tide goes out. And this time around, the tide has revealed, hasn't it, a gig and informal economy, people with extremely low financial resilience, systemic issues of inequity and persistent poverty, and a health crisis that has very quickly become a severe economic crisis. Just yesterday, the chair of the recruitment firm Reeds said in the FT that there was a tsunami of job losses, was a real possibility, talking about 5 million unemployed. That's about 15% of the workforce. For context, the impact of the financial crash back in 2008 saw unemployment rise to 8.5% in 2011. And you have to be a bit older to remember back to 1983, in the days of Maggie, to remember figures of nearly 12% unemployed. So we've seen some astonishing measures so far. Millions of workers furloughed until the end of July on 80% of pay. A contraction of consumption seemed unimaginable, down 40 to 50%. There is nothing to purchase, no holidays, no cars, no weddings, and there's been a huge drop in incomes. Maybe not necessarily everybody on this webinar, but there's been a huge drop in incomes of around negative 30%. All this, an all too familiar story of the disproportionate impact on the poorest households. Banks trying hard not to be the villains of the piece this time, offering payment holidays, payment breaks, interest-free overdrafts that could last yet a few months more, and the FCA, through Maggie Craig, will hear later, talking about how they are making sure that lenders do the right thing for consumers. The crisis for social lenders is best summed up as loan books contracting and quality reducing. And that's really an impact on all lenders, not just social lenders. They are all bracing for the hit, pipelines are damaged, and there is a likely rise in bad debt. UK governments, devolved governments, all offering grants and loans to help. Some lenders on this call will have benefited from that, and I'm sure are all hugely grateful. But there is a danger, of course, that the short-term stimulus could lead to a long-term solvency issue. Our survey is taking the pulse of social lenders. You can see here we got 63 responses. That represents over 20% of the affordable credit sector, and even higher if you use a different metric of volumes and savings, it's nearer 50%. We've got all the leading personal lending CDFIs in the country as part of the survey. A pretty even distribution in terms of those with loan books under 2 million, those with loan books well over 10 million. In short, these are lenders with long established histories working in their communities of place and communities of interest, and this survey stands up to scrutiny. It doesn't tell us anything we individually hadn't been seeing before, but it does turn anecdote into evidence, and Paul will now talk you through the main findings. Paul, remember to unmute, Paul.
Thank you, yeah. Thank you, Neil. So what we can see from the survey is that COVID has already had some immediate effects on the sector. Well over half of providers have furloughed staff. Those that furlough staff tend to have a larger number of branches on average compared to those that don't. So 3 compared with 1 for those that do not furlough. And that's perhaps not that surprising given that many have had to temporarily close their branches and obviously had to furlough some of the staff working in those branches. So those that furlough staff have furloughed around a third of their staff on average. There's also been an increase in loan payment holiday requests. 94% of providers report that they've seen an increase. The average growth in such requests is astonishingly high at 130%. Part of the explanation for this is that many credit unions have reported having no such request or very few prior to COVID. And about 2/3 are concerned about the increase in payment holiday requests. And part of this concern is really that these requests will a number of them will lead to arrears and write-offs further down the line. So close to, if we turn to the savings, close to 80% of credit unions report an increase in savings, which is rather counterintuitive perhaps. and the average increase is around 14%. And around a third are concerned about this trend, and 5 credit unions say they have taken some steps to reduce this. And follow-up interviews we did suggest that this concern is, which again sounds strange of credit unions not wanting savings, but it's really around how this has a negative effect on their capital asset ratio as they increase savings but decrease lending. So turning to lending, this is perhaps the most dramatic slide, but we've seen a dramatic fall in the volume of lending, especially in April 2020. So the value of loans dispersed in April this year fell by over 70% compared with April last year. And the number of applications and loans fell by 40 and 50% respectively. So the 59 providers that gave us data on volume say that they made more than £16 million less in lending in April 2020 compared with April 2019. So that's quite a big drop. And Neil and I have done some very rough back of the envelope calculations suggesting that this leads to sort of £3 million in lost interest income down the line, assuming 1.5% APR in a term of 24 months, which is sort of the average for the sample, but not taking into account bad debt. On average, we see smaller loan amounts in April, perhaps suggesting that providers are made smaller loans than usual to customers to help them bridge temporary gaps. And also, follow-up interviews also suggest that lending is recovering slightly in May, but it's for most but not all providers, but we're still not seeing up to sort of pre-COVID. So turning to, so despite sort of these falls in lending volume, the majority are still fairly confident about the situation regarding liquidity and viability. 80% of those we asked do not think they'll breach any regulatory ratios or loan covenants in the next 6 months, and 65% think they'll be able to meet short-term costs without additional support. 90% are fairly or very confident that they'll still be trading this time next year. I think it's important to highlight that, you know, there's a huge amount of uncertainty here. And in the follow-up interviews, a lot of the managers stressed that, well, we're reasonably well capitalized to weather the crisis, but a lot will depend on how COVID unfolds and what are some of the long-term economic effects, because there were, in the interviews, there were concerns about what the effect of bad debt, of falling interest rates, increasing savings and low demand will have on viability in the longer run. Next slide, please. Yeah. So in summary, what we've seen is that 56% of lenders have furloughed staff, and on average, just around a third of their employees. Over 90% of providers have seen an average of 130% increase in payment holiday requests. 78% of credit unions have seen an increase in savings deposits of an average of 14%, and there's been a 70% drop in the value of loans issued in April 2020 compared with this time last year, and that's equivalent, according to our back of the envelope calculations, of more than £3 million in lost interest income. Despite this, still 65% say that they can still meet short-term costs, and 54% are very confident that they'll still be trading come April next year. Thank you.
Thank you, Paul. Thank you, Neil, for that brief summary. And as I said, there'll be more data available on the website in the weeks to come. And I finally found a way in which Neil is muted, which has taken many years to get to that point. Now we're going to hand over to the panel members to respond to those findings. They've had cited them in advance. First up is Robert Kelly, who's the CEO of ABCOL. Robert, over to you.
Thank you, Carol. Thank you. Thank you, everyone. Thank you, all panelists, for the opportunity to be here today. As Carol said, I'm Robert Kelly, the Chief Executive of the Association of British Credit Unions. Delighted with the opportunity to be involved. I think from our side, just the first sense check on the data. We have been capturing data wherever we can from our member base over the last couple of months, and where that's taken us, as it looks like it's roughly 35% of loan business that was forecast or expected to happen in those months of March and April. That's the level that was reached, and so that absolutely ties in with the broader data that we've seen today. So I think the first point I would say is that, and Michael talked about it earlier, and other panelists, the need to promote financial resilience for consumers and credit union members, CDFI customers all across the country and across the world, and that bit around financial resilience. And I think that's echoed for the impact that this will have on this sector. If we focus, as you can imagine, I will focus on the credit union sector, and I think what the data suggests is that the questions that need to pose, the thoughts that need to be given, how do we as organisations, stakeholders, trade bodies, credit unions, and amongst this, try and support each other in the months ahead? How long will this COVID crisis last for? What impact will this have in the longer term on the financial resilience of income and expenses statements and balance sheets across the country? How well prepared are we for this downturn? And we've been talking internally within ABCOL, and the idea that there's always a consistency in terms of that growth pattern, and that we don't hit these speed bumps, as we know, very reminiscent in some ways of 2008, 2009, and I can firmly say that my experience of running a credit union at that time, that there was a big upsurge in new deposits, because people were looking for the credit union as a safe haven when the banking sector had lost virtually all credibility, and there was serious concerns about its sustainability. And I think people are using the credit unions now as a savings mechanism, additional savings to promote that financial resilience. Probably a bit different from the reasons in 2008, but nonetheless, that's putting pressure on capital asset ratios. It's putting pressure on the overall business model. So I suppose my observations are, what are our businesses doing? What are our organisations doing to stress test their ability to withstand this shock? What does that look like in the short to medium term? Do they have enough resilience in their capital levels to see them through this shock and this downturn? And how do we then come out the other side? And I think that bit are about the recovery, and there's been lots of talk about what shape the recovery will be, and there's people eminently more qualified than I have got different ideas on that. And I for sure think it's about, from an affordable credit union sector perspective, it's all about what opportunities are also out there. Let's stay positive within this. Let's talk about the way that we can deepen the relationship with our customer and member base. Let's talk about the way that we can ensure that member loyalty is more embedded in the months ahead, that when the economy starts to recover and people's risk appetite around lending and all of those different things, it starts to change a little bit from where it is now, that our sector will be seen as the go-to place to continue to promote ethical savings and affordable and ethical credit options. So I think there's a real opportunity for deepening that relationship, whereby we have the opportunity to say, we were here as organisations to support you through this crisis, and we will be here at the other end, and it's a long-term commitment. As always in our sector, collaboration and cooperation is critical, and we've seen great work on that, and this is just another example. I think it does give us this evidence base to talk to regulators and legislators about the challenges for the sectors ahead. I've seen it reported somewhere that this is about a portal between the old way or the existing way and a new way, and perhaps there is something there about you know, how do credit unions, how do affordable credit providers make sure that they have a longer term sustainability plan, and what do we need to do to try and support that? So there's lots of challenges, but I think, let's be positive, there's lots of opportunities to capitalise on that member relationship. And just finally to wrap up, there's been, from my comments, there's been some reflections in terms of financial services. What does it mean for financial services overall? And I thought that this really struck a chord in terms of the themes that were covered. The first bit is, you know, how do we put members at the very centre and the forefront of our value proposition as organisations? What does product and service innovation look like in there? Secondly, how do we continue to transform the service delivery model? Because we know for sure that people aren't going to necessarily go back to the old ways of working. And thirdly, you know, how do our businesses navigate that external economic environment? How do we support them through these tough times and beyond? So again, thank you again for the opportunity to be involved, and, you know, delighted to be here and offer some reflections. Thank you.
Thank you, Robert. That's great, and it's good to hear your reflections, and also your positive suggestions of the way forward, which all I think are very relevant. I'd now like to invite Theodora Hadji-Michael to speak on behalf CEO of Responsible Finance. Theodora, over to you.
Hello, everyone. Thank you to Carnegie and Salford for conducting the survey and organizing the presentation today. The findings are broadly consistent with the feedback we've received from our CDFI members during the course of the coronavirus crisis, and they portray the unprecedented conditions that affordable lenders are operating within. I also wanted to acknowledge the positive contribution Fair for All Finance has made towards the sector's resilience during this time, which some of our members have been able to benefit from. The survey results that Paul just presented clearly illustrate the need for the Resilience Fund, as well as highlight the ongoing challenges facing the sector. I wanted to just draw out a couple of points made in the presentation. First, on the point around an increased portion of loans in capital payment holidays. CDFIs were proactive early on in the crisis about contacting their customers, understanding how COVID affected their finances, and offering forbearance if it was needed. This speaks to the strength of the sector in knowing its customers and providing high quality support. Our members' customers are some of the more financially vulnerable and hard to reach customers in the UK, so the support that CDFIs provide is essential to enabling them to be in control of their finances, especially during this time of uncertainty. Second, the drop in demand for credit and the impact on the quality of new loan applications. Our members have seen more demand for credit to pay for essentials such as food. It isn't sustainable to lend for this purpose, but this and the previous point around repayment holidays indicate that there is an underlying deterioration of many consumers' financial health. And it raises the question of what happens to these consumers who are now in vulnerable circumstances. Clearly, further support is needed for them. This brings me to my third point around other services and support that build financial resilience. Although it was not reported on today in the presentation, the full survey data shows that the majority of affordable credit providers did introduce new products and services over the past couple months. And we've been impressed with the agility and innovation within the sector to ramp up non-financial support, such as budgeting advice, and accelerate technological developments to ensure that customers are getting the right support at the right time, and that support is easily accessible. Alongside this, we've seen really great work done within the CDFI sector to segment customers to understand how to triage acute needs. These 3 points demonstrate the crucial role that the sector plays in reducing the overall impact of financial hardship and helping people bounce back faster. Overall, CDFIs have been taking intentional steps to prepare for the continued uncertainty in the coming months. But looking ahead, and the survey results, along with other macroeconomic data out there, show that it will be challenging for affordable lenders and their customers due to a loss of income both from their existing loan books and lower volumes of new loans coming in. So clearly these aren't normal times for CDFIs and their customers. So at a time when the sector is most needed, the resilience of the sector itself is also being tested. These organizations operate on thin margins during normal times as it is, and it's not sustainable for them to have such significant reductions in interest income on an ongoing basis. This is why I think we need to do more, So to be effective, we all need to work together to first raise awareness of the perception barriers, raise awareness so that the perception barriers for the sector are reduced. We need to source funds for the sector to deliver hardship grants and no interest loans to help consumers get by. And we need to provide parity with the Fair for All programs in the devolved nations. I think with the continued support of the organizations on the call today, our sector can make a significant impact on people's lives throughout the economic recovery. Thank you.
Thank you, Theodora, and I think you're quite right with your observations of both about the challenges the sector faces and the responses, but I think also about the client group. And I think one of the things that's often overlooked, I certainly overlooked it myself, was that the furlough scheme is a fantastic scheme. There's no doubt about it. It's saved, many millions of families from falling into complete destitution over a very short period of time. But nevertheless, an 80%, if it's an 80% coverage, if someone, often the people that we're serving rely also on their overtime. So actually their income has dropped by more than just, the 20% off 100%. And I think we shouldn't neglect that when we're thinking through the longer term impact on people's household budgets. I'd now like to invite Maggie Craig, the CEO of the Scottish office of the FCA, to make her response. Maggie, over to you.
You're on mute, Maggie.
You're on mute, Maggie.
Right, let's try that once again. How clever is your regulator? She can't even unmute herself. I do apologise. Firstly, I would like to thank Carnegie for the opportunity to speak here and really welcome this work that you've undertaken, because I think this whole environment, this whole pandemic has been so fast evolving that getting facts to hold on to has become absolutely crucial. So I think what this presents us with in the session today is an important opportunity to discuss the data that the survey offers, and also, as we've seen with other panelists, to start to take stock and reflect on what the data is actually telling us. And this piece around lending is really important because it's a fundamental principle that a well-functioning lending market is essential to a healthy financial services market. But this challenge is absolutely unprecedented and actually poses a challenge to that very principle. So there's a lot to be thought through in the lending situation. We know at FCA that the impact of COVID-19 has delivered a significant shock to the credit union sector, and it is clear that the impact will continue to create challenges for the sector over the weeks and months ahead. However, on a more positive note, one of the things I would like to just point out is that we think it's very reassuring to see the positive efforts and the swift actions taken by firms, their key workers and their volunteers right across the sector, supporting local communities and extending forbearance to their members who are facing unexpected income shocks, as we've just heard, and very often income shocks of more than 20%, all caused by the crisis. I'll focus on two key points, I think, that I just wanted to touch on: reduction in lending and forbearance. Thinking of reduction in lending first, COVID-19 has been a significant shock to the sector, not just in financial terms, but operational terms, and the impacts are being seen now. This is not a crisis that is just going to play out in the longer term. It is playing out now and in the longer term. The supervisory feedback that my colleagues are getting from the sector suggests declines in lending when compared with this time last year, as does the survey. In particular, we believe it is the smaller institutions who are more likely to experience the greatest struggles and may be the first who need to reach out to ask for assistance. That may be through additional sources of funding, as we've heard, exploring government support packages, or indeed it may mean engaging promptly with the regulator when they start to see issues on the horizon. Interestingly, I was very interested to note from the survey the point that many firms, just over 80% if I remember the figure correctly, remain optimistic that they don't forecast a breach in regulatory requirements or loan covenants. And also that over 60% feel that they can continue to meet their short-term costs and obligations under the current circumstances for the next 6 months. Now, that's not to minimise what's going on, but it is two interesting points to pull out. And we can see from our work that firms are taking steps to manage their provisioning, including engagement with our sister regulator, the PRA, following recent modifications to the provisioning rules. As we always do, but even more so in these current circumstances, we encourage all regulated firms, engage early with us, with the regulator, with us, with the PRA, should you believe that your circumstances may change. I can't stress that message strongly enough. Touching now on forbearance, we do see again from the supervisory work that the credit union sector is geared up for forbearance. And it may sound a little odd to say it, but historically, we know this sector does apply appropriate forbearance. And I wouldn't want to overplay this, but that does mean to some extent, therefore, that forbearance is a kind of business as usual mindset, although in very unusual circumstances at the moment. From what we have seen during our engagement with firms and PRA colleagues, the sector actually seems to be dealing well with the impact on forbearance and being proactive in terms of engagement, particularly with vulnerable members. So I think I would conclude, my concluding reflection would be that naturally the impact of COVID-19 is dominating the agenda everywhere, not least in the credit union sector and at the FCA. But we still expect credit unions to abide by our regulations. If there are problems, let us know, and let us know as soon as possible. But just to remember, while there are clear challenges, we are very pleased to see that credit unions are holding to their principle of being there to support their communities, particularly those members of the communities who are vulnerable in these extremely difficult times. Thank you.
Maggie, thank you very much indeed for your contribution. And again, welcome to everybody who's with us here in this webinar today. Some fascinating facts and some fascinating contributions. I'm enjoying too seeing one or two questions appearing in the question and answer Q&A section, and I'm also noting some of the points that are going past in the chat, which we may come back to later on. But now it's the turn of Dermot O'Neill, the CEO of the Scottish League of Credit Unions. Dermot, over to you.
Thanks, John, and hello everyone. The Rapid Response Survey paints an insightful picture of now, but I want to use my 5 minutes to look ahead, particularly on the challenge for firms, whether they're credit unions or CDFIs, in the context of the new normal. And I use that phrase consciously and deliberately, very aware of its current prevalent use, because it's important that firms don't view this current period as just something to get through before things get back to normal, because trying to get back to a previous state is a wasted opportunity. Instead, COVID-19 could be a positive opportunity for all firms to press pause, to lift their head and plot a new, deliberate direction of travel, asking themselves, why do we exist? How do we make a difference in the lives of ordinary people? What is it that we do or could do better, smarter, quicker, or more ethically than other vendors? We encourage our credit unions to holistically review their business through 6 perspectives: strategy, governance, operations, financials, reputation, and compliance. And I'll run through those 6 perspectives. On strategy, we're asking, has the mission of the credit union changed, or is a reset required? Have the goals of the credit union changed? Should the credit union update their objectives and KPIs? If so, we're encouraging our credit unions to take this opportunity to rethink how they strategically plan, reminding them to link their business planning elements together, their SWOT, their risk analysis, to SMART goals, so that there are no orphans. If there's a threat, weakness, or risk, address it via a goal. If there's a strength or opportunity, embrace it and progress it via a goal. On governance, it's all about the people. Good governance is the commonality of thriving firms. Conversely, poor governance is a root cause of failing firms. So we encourage our credit unions to review, do they have the right people on the bus and in the right seats? Are they recruiting, retaining and training people with the necessary blend of experience and youthfulness? Can they identify capability and competency gaps? And if so, how will they address those gaps, linking back to an overarching strategic review? On operations, firms know what they do. They provide affordable credit. But COVID-19 should be focusing firms' thoughts on how they do it, physical versus virtual, bricks versus clicks. Are firms on a digital transformation journey to enable electronic onboarding, straight-through processing, modern delivery channels, automated lending decisions, intelligent marketing campaigns, and event-driven credit control? It's important that firms view this channel shift in the context of as well as, not instead of. It's not about pushing customers away. It's about reducing the friction in the experience and bringing them closer. On financials, COVID-19, as has been described, is the perfect storm. So all firms should be scenario planning. We're encouraging our credit unions to play around with their numbers, almost in a sandbox mode. What does the next quarter look like? What does the next year look like? What does the next 3 years look like? Do the numbers stack up? Have the numbers been stress tested? What would happen if this, then that? We're asking them, are the graphs and trends pointing in the right direction? If not, react and plan accordingly. Again, ultimately linking back to an overarching strategic review. On reputation, in the same way that will be a new normal, there'll also be a new customer who may think differently, who may buy differently, who may want to interact differently. For some members, their credit union is to help them on a rainy day. Well, that day is here and it's pouring. So we are asking our credit unions to review what they're communicating, to whom, when, how and why. When the dust settles, members and customers will ask, was my credit union there for me when I needed it most? And if the answer is no, then that relationship may be tainted or even lost. And lastly, on compliance, credit unions already operate in a veritable spaghetti junction of laws, regulations and rules, and many credit unions already struggle to make sense of, navigate and comply with the myriad of requirements. Add in the reduced organisational capacity of some firms and it makes compliance even more difficult. It's also inevitable that the impact of COVID-19 will negatively impact the key ratios for all firms. So we encourage our credit unions to review what they should be doing and when and by whom, and also reminding them that they're not alone in this challenge. We're here to help. Now, more than ever, it's the time to reach out and ask for guidance, to connect with other credit unions, to share experiences and to collaborate on solutions. Ultimately embrace the premium spirit of cooperation and people helping people. I could say more, but I've been warned by Alexander that I have 5 minutes max and I think my time is now off.
Darren, thank you very much. You were right to the point, as you always are, and you know, like it's odd to be told by Neil Alexander to be brief, but there you are. We live with new experiences every day at this time. Thank you very much indeed. There's some very interesting points that we need to come back to there, and I see some more interesting questions appearing in the Q&A section. So, David Ross, it's your turn now. David is the CEO of the Glasgow Credit Union and National Credit Union Forum.
Hopefully you can hear me. And thanks to everyone involved in organising the survey. Really, NCUF welcomed the opportunity to participate and being given a few minutes to summarise our thoughts. So I'd like to cover off probably 2 areas if I can today. And the first one really in relation to recap on the impacts on our credit unions and ultimately our members. And then actually in Dermot's point that was made, a few points on the options in response. So firstly, the impact on our credit unions and our members. I think the data, as I mentioned earlier, there were no surprises in that data, and it really supports some of NCUF's recent discussions and concerns. The increase in savings in the data, we believe, is actually a combination of the increased deposits that members are making, but also the reduction in withdrawals. And this does mean that there's that added pressure to lend the money out in order to continue to provide that return to our members. However, as the data actually shows, there has been a massive decrease in lending, and this impacts on our immediate income and puts that extra pressure on the capital ratio. it also puts pressure on trying to make the best use of our members' money, and ultimately will impact on future cash flow and income, especially with the low net margins that we're working to the sector just now. I think the data also supports the premise that we can expect higher consumer debt following the deferred payment breaks that Maggie referred to. And these have been taken by many members to get through the current circumstances. But I do think there will be the resultant need to provision for that increasing bad and doubtful debt. I think there's also a real risk here that consumers will see some of the existing legal instruments, such as protected trust deeds and individual voluntary arrangement schemes, as potentially easy routes out of their financial difficulty, without perhaps appreciating the implications. And this could have a detrimental effect on those that are already vulnerable, and will obviously have an immediate financial impact and loss for organisations to manage. I suppose, in summary, in normal trading conditions, any one of these impacts would present a real challenge to any well-capitalised and viable credit union. However, in the current economic climate, they will collectively represent the perfect storm, I think, and will put pressure on credit unions and CDFI's operating models. NCUF is concerned that if the data is representative and applied across the sector, then we could see many of those credit unions failing. Consumers could be faced with fewer lenders providing fewer affordable credit options. However, I didn't want to focus just on the impacts, because I think there has been a mention of the real opportunities here. So I would touch on NCUF's view of some possible options in response. We have certainly seen some small positive signs that lending is picking up recently. And as was mentioned by Robert, there's been some excellent working that has continued across the sector, from credit unions, trade associations, regulators and government. And as NCUF, we would ask that those current actions are supported, wherever possible, accelerated, and then a few others perhaps considered. So, for example, maybe some form of integrated lending plan or support packages that could enable credit unions and CDFIs to continue to provide affordable loans at even better rates. Maybe perhaps some short-term debt support, similar to the banks, for amounts above what we were managing pre-COVID-19. We think our regulators and government departments should push through the legislative reform to allow the opportunity for some credit unions to introduce additional products and services where appropriate and within their own risk appetite, but not at the expense of other credit unions who choose not to introduce them. I think other surveys and statistics have highlighted the limited financial resilience of UK households. However, we think the data presented today suggests that there has been an improvement in that somewhat as the savings have increased. Therefore, there is an opportunity to review how the regulatory ratios could take that positive outcome into account in our future management of our accounts. I think the vulnerable customers could perhaps be provided with even more support by introducing temporary measures that could force perhaps insolvency practitioners, the free debt agencies, and lenders like ourselves to work more closely together to agree solutions for the mutual benefit of those in financial distress, with even more appropriate and responsible payment options and plans. And there is also the support required to create new service companies, especially those for credit unions and CDFIs with centralised back office services, affordable lending products, which could be delivered more effectively from a cost and efficiency perspective, ultimately benefiting all of our members. So we don't believe there's a magic wand, but these and many other options need to be fully considered in order to protect those that are most vulnerable and those organisations that we believe serve them best. So thank you, John.
Thank you, David. We're doing remarkably well here for time, and some fascinating reflections there as well. Sasha, Romanovic is the CEO of Fair for All Finance, and I know that Sasha has to leave us at 5 o'clock, so we've got to you just in time, Sasha. It's over to you.
Perfect, thank you. And thanks everybody, and particularly Michael Sheen for his introduction. Michael was the source of inspiration and challenge that led to the founding of Fair for All Finance. And so it's great to see you back in the arena, so to speak, and also to Carnegie and the team for commissioning the research and everyone who participated in it, because I know everyone is phenomenally busy. What I wanted to really pick up on here is, I suppose, taking that thread from Dermot in terms of the forward look, because I think that the data speaks in some ways for itself. And I was going to start off with a quote from a Canadian ice hockey player, because why not on a summer's afternoon, which was skate to where the puck is going, not to where the puck has been to be successful. And what I just wanted to explore were really three different aspects. One was the context in which we are looking forward, and particularly some of the work we're doing at Fair for All that may be able to assist you in thinking about that in your organisation. The second is really thinking about change and adaptation and what it is that we can actually do to really appropriately respond to that context and recognise where are there temporary changes and where are there changes that are actually maybe more permanent that you really need to build into your future planning to be sustainable as organisations. And then the final bit is our role, which is very much as a catalyst. So let me just start with the context side of things. And I think that there are two really interesting themes in terms of what's going on. One is customer needs and their behaviour. We're seeing something that's quite different in terms of the post the 2008 crisis, that a lot of people, and I've been speaking to some individuals today, are actually focusing on paying down debt because they see this as a long haul. They see all the figures in terms of unemployment. They don't want to be in a position where they're going into that with significant debt. So there is a lot of buckling down. And interesting in terms of lending, the high cost lenders are all seeing significant decrease. The one area that's increasing is basically lending for stuff. And I will use stuff advisedly, but we have both PayPal, we have Klarna, we have a number of new providers coming into the marketplace, giving people credit at point in sale, which is actually significantly shifting the environment for customers. And so I think that's a really important dynamic for everybody to think about, is what is it that customers are looking for and how do we best meet their needs? And also what is happening with the competitor marketplace? We're seeing an overall contraction in the marketplace of high cost credit. What are banks going to be doing? The provision of the £500 free overdraft has actually created significant additional capacity. How is that going to change? Now, we're doing a considerable amount of scenario planning at the moment, and our intention is to make that available to you all so that you've got additional tools to be able to look at your business model and how that remains appropriate in the context of those wider market dynamics. Much attributed to Darwin, although apparently it wasn't, is that it's not the strongest of the species that survives, nor the most intelligent. It's those most able to adapt to change. And so I think that's my second message from this, is that, you know, undoubtedly there will be some permanent changes to the marketplace as a consequence of this pandemic. And being able to anticipate those and identify how are you going to adapt your business model so that you can thrive in that new normal that Dermot talked about is going to be pretty important. And I just focus you to look at probably three different aspects. One is, you know, a sustainable business model on a really basic level is your income greater than your costs? And if that income model has shifted, how will you change so that you can actually make those sums work? Scale and efficiencies really come into it. It's why we often look at scale and what we're doing. And so I would encourage you to think about consolidation with a caveat. You don't tie two drowning people together and expect them to be able to swim. It doesn't work like that. So really being able to think about synergy in terms of back office systems, customer base, what you could potentially do if you were joining up with someone else, I think is a really great opportunity at the moment. And I think one of the questions in the thread was about shared back office, etc. I think there's a great opportunity there, but it requires considerable collaboration across the sector. And I'd say, you know, there are lots of different trade bodies even in the room. And from a outside perspective, I think that it is absolutely essential that you are able to collaborate together to make sure that affordable provision is really developed well, and that the high cost providers are actually your competition, not each other. So I think that's just something that is really important to pay attention to. Finally, in terms of our role as a catalyst, we put out the Resilience Fund. We allocated £5 million. We've deployed 3 million so far. We will be continuing to deploy that. Increasingly, however, we'll be looking to support changes to business models to allow that long-term sustainability. The key thing probably in terms of our work, as you're aware, is that our money comes from the Dormant Assets Fund in funds allocated to England. That does cause frustrations. It means that our work has to significantly benefit those living in England. We would be delighted to work with devolved authorities to be able to extend some of the funding aspects of our programs into the devolved nations. But what we are intending to do is to make sure all of the tools that we're developing will be made available to every organisation in the UK that can benefit from them. So I think I set my timer. I've gone 50 seconds over. So in a very brief snapshot, I think if I just say, make sure you're really looking at what's happening with your customers in your market, really look at how you need to adapt your model to be sustainable, and really think about how you can collaborate, and we will do our utmost to be a catalyst. But I think we cannot solve the issues on our own, but we'll collaborate with you to try and make the most difference that we can. Thank you.
Sasha, thank you very much. Now I'm going to curtail my contribution because I think there are a lot of interesting questions in the thread, and we're getting close to 5 o'clock. But I want to thank everybody who's contributed so far. I want to thank Salford University for this piece of pro bono work that they've done, along with the Carnegie UK Trust, to take what we thought was true and show us by the facts that anecdotally what we thought is actually what is happening in reality. It's a remarkable thing, I think, that Carnegie and Salford have done at this time to put something in place so quickly, and to get us to a place where we begin to understand better what's happening out there. Michael said right at the beginning, we need to be ready for the world after COVID-19. Because if we're not ready for it, others will be, and they'll swoop in and they'll exploit the poorest, as they always do. Those of you who know me and know my background know that I belong to the church, and in the church just now we're trying to predict what the future will look like post-COVID. They've closed all our churches. Our people can't come to church on a Sunday morning. We've gone online for most of our worship, and we're having to think what the world will look like beyond this pandemic. And we know that it's not going to return to normal. It's going to return to what we call a new normal. So what does that new normal look like? You know, that new normal, we've been told, probably means increased bad debt, because all these holidays that people are taking from mortgage payments and from other debt that they have on the books. And we've got organisations here, 31% of them saying we're worried about that. Well, they're right to be worried about it, I think. And we need to be ready for what comes next. There's been a number of interesting points made today, which have led me to believe that what we've done over the last few months to provide the research and the statistics that we've had today is something we need to keep on top of. We need to keep running the models. We need to keep scenario planning, and we perhaps need to do this piece, repeat this piece of research, or go into it to an even greater depth. And I wonder if there's a couple of pockets out there, deep pockets, that might help us to take this research forward and learn more as the next 3 months play out. because those who can predict the future here and see what it looks like are those who will be best able to serve those who most need us. That's all I want to say at this stage. I want to hand over at the moment to Douglas, who's been picking up on the questions, and maybe Douglas, you would farm them out to those who might be best placed to answer them.
Hi everyone. Thank you very much for all the really thoughtful questions that you've been posting throughout the session. Those of you who've been looking at those will see that unfortunately we will not be able to get through all of those just now. But what we will do is capture them and come back to people as part of the follow-up for the session, taking input from panelists as they're able to provide it in order to give you some feedback on those. So if you don't get a view from a panelist today, fear not, that we will hope to and aim to come back to you over the coming days with some thoughts. I'm also conscious that each of our panelists could probably give some really insightful reflections on each of the questions that we're going to pose, but that in the interest of time, we won't seek to do that, and we won't seek to put every question around the panel, but I will pick out certain questions and direct them to individual panel members for their immediate reflections. So I want to start just with a couple that came through on the kind of regulatory end of the scale. And if I could direct the first one to Maggie, because there was a question for the FCA around what potential there might be for some relaxation of FCA rules. I think in particular in relation to issues around credit history and affordability to enable affordable lenders to meet people's needs at this time. And just whether she had any immediate reflections on whether that was something the FCA was looking at or would be open to looking at over the coming period.
It's not something that, as far as I'm aware, we're looking at the moment. I think, though, I would link it into the wider question. We are very conscious of what we've done in terms of mortgage repayment holidays and credit repayment holidays and motor finance repayment holidays, but we did that very much in reaction to the emergency, and we're also doing an awful lot of work about what happens to those in the future, what are the long-term implications, and how do we take those forward. And at this stage it's very difficult to know how wide that work will go, but you can see that question kind of sits within that. So I think the answer is we're not planning anything immediate in that space, but I think there's a theme emerging from today, which is about what is the world going to look like in the future. And there's no doubt that the world's going to change, and we will have to be on top of that change. I can't be more specific, Douglas.
Thanks, Maggie. That's a helpful steer for people, I'm sure, and also for people to keep thinking about the types of interventions that they would find useful, I'm sure, and to keep communicating that with you and your team as appropriate to help with that thinking. Keeping on the kind of regulatory theme, there were a number of questions that came through in relation to savings ratios for credit unions, and whether those were the extent to which those are problematic and the extent to which change in those regulations may be possible or desirable. And I was hoping that Robert, you might be willing to give some perspective on those particular queries that have come up. So if I could hand to you to consider that question.
Yeah, no problem, Douglas. I mean, I've kept an eye on the questions, and I think that I'm sure people would agree that we are about responsible credit, but we're also about responsible saving and creating that savings culture. So I think it's quite a hard one to balance in terms of cutting off that option or not promoting the savings at this point in time. But we recognise that the knock-on effect is that it's putting pressure on certain key ratios for the credit union sector. I've saw some of the questions there about perhaps a movement towards the Help to Save scheme that the government have, and I know that we certainly ABCO looked at that, and it was proving quite difficult for some of that assimilation because of the technology requirements at the HMRC side. So I mean, and that's just at a very practical level. So I would say that where we can, we should continue to talk about safe savings and affordable credit, and try and make sure that we can monitor those as best we can for those key ratios. We can support credit unions in the choices that they make. The knock-on effect as well is that deposit rates. There is talk about negative interest rate territory through the Bank of England, and we also need to recognise that at this time credit unions can ill afford to lose any further income in terms of deposit income, albeit the rates have been historically pretty low. So there are some challenges that we're keeping an eye on, and there might be some regulatory impact on that as well. But as a core concept, I would be very reluctant for credit unions to move away from the stance that we are here for, to provide that savings mechanism, even if it's just in a very small way at any given time.
Thank you, Robert. So to take the questions into a slightly different direction, we had some questions around how the crisis is either throwing up different needs of those who might use credit unions or CDFIs, and what, I suppose, potential the sectors might have to support people with those other needs in terms of getting access to other grants or forms of support that might be available to them, and taking, I suppose, a wider lens to tackle financial exclusion. And Theo, I was hoping that was something that, following on from your remarks, that you would perhaps give some thoughts to for participants on that kind of wider kind of tackling financial exclusion role that CDFIs or credit unions might be able to play.
Yeah, sure. Thank you for that. I think it's definitely an opportunity, first and foremost, because CDFIs and affordable lenders in general have the reach into those markets of consumers who need a wider range of support the most. So within our membership, there's a lot of interesting models, but what we're seeing a lot of during this crisis is triaging. So providing non-financial support, such as access to budgeting advice, benefits checkers, and so on, conditional offers based on taking up debt advice or gambling advice, things like that. Provide wider wraparound support, access. You mentioned access to different grants. Community lenders and affordable lenders are very well embedded within their communities and are aware of the other supports on offer. So, for example, a lot of I won't take up too much more time, but a lot of times they have they second staff from other organizations to be able to provide those links. So I think going forward, it's an area definitely to explore how we might be able to build on that and create a more joined up financial services sector for vulnerable consumers in the long term.
Thank you very much, Theo. David, I'm going to direct the next question to you. I think we'll try and capture two more. So David, I'll come to you for this one, and then Dermot to you for the final one before I hand back to John. So David, there have been a number of questions in the Q&A around potential for greater sector collaboration, whether that's back office functions, whether that is mergers. It's something that you touched on in your own remarks and something that Sasha picked up on. So I wanted to give you an opportunity to come back in with any further thoughts or reflections on any of those points and some of the opportunities and challenges that exist within that realm.
Probably take the opportunity. Can you hear me? Yeah. Okay, so I'll probably just take the opportunity, Douglas, if I may, to cover off probably the collaborations in relation to back office services, those types of organisations, fintechs, for example, that have been helping many of us individually with products, with services to our members. And I think there's a collective view that has been there for a number of years that there's probably more that we could have done, similar to the American model of service companies or service offerings. However, it doesn't come without its dangers. But I do think if I take one that's being discussed within NCUF, specifically at the moment, is some form of collections service or collections opportunity. To pool either a group of resources across all the credit unions, or perhaps to set up something as a unique entity in its own right. And that would be really because if we look at the members of NCUF, we all have a number of individuals, or in some cases, no dedicated resources doing some of those activities. So by pooling those resources or creating something that provides us a service, it can focus on that and hopefully deliver it much more efficiently and effectively than any of us could do individually. So that's the type of initiative that I do think we have to explore further. There are many others that have been discussed in terms of website delivery, in terms of applications that members can use, because in the main we all have a lot of different back offices to hook into and integrate with. Therefore, it becomes difficult just to create a single use entity. So we have to be careful about it, but I do think the point's been made before, and we really need to grasp it at this point in time. If we don't, I think it will be a missed opportunity, a lost opportunity.
Thank you, David. So Dermot, final question that I'll collate from the queries that have come in before I hand back to John, and it really builds, I think, on some of the things that you were talking on in your remarks. So we had questions which have kind of been alluding to, that the pandemic has required the sector to test its own sustainability, its resilience, and strategy planning. But there are a whole host of other things that we know are coming that require that as well. Whether it might be Brexit or the climate emergency, I've been referenced in a couple of questions. So what does that mean for the sector in terms of how it should be thinking about how it plans for its own resilience and how it builds into its strategy thinking, how it can deal with unexpected crises in order to achieve that sustainability. I wondered if you'd like to give us some final remarks on that point.
Douglas, have you just asked me to solve Brexit and climate change in the last 4 minutes? And if so, I'm afraid I'm not capable of doing that. But
I could add another one for you if it's too easy, Dermot.
No, please don't. But what I think every firm can do is think. Every firm in this moment can pause. They can draw a line and they say, that was then, that was what we done, and that was why we done it. That was who we done it for, and this is how we done it. And I think now is the time for firms to draw a line and say, what could we do better? What could we do differently? How can we design our offering with our members and customers at the heart of our decision making, at the heart of our planning? How can we make sure that our offering currently and going forward is what customers need, is what members expect, and take this opportunity to create a new offering, to create a new environment that's relative to the members' needs, rather than existing by momentum as some firms have done in the past. Use this opportunity to sandbox their numbers. To all of the trade bodies will have products available that helps their members understand what their numbers are saying. So let's look at the numbers. Are they going, is the direction going in the right direction? And if not, what levers are available to change the direction of the numbers? What levers have the most impact when we push or pull them? And really get to the heart of the mechanics of the business so that we understand which levers are worth bothering with and which levers are best left unadjusted.
Thank you very much for that, Dermot. That's a really helpful concluding remarks. And thank you to all panelists for being so succinct and insightful in their answers to the questions. And thank you to those who submitted them. And as promised, we will try and follow up on those that we're not able to cover just now. Back to you, John.
Thank you, Douglas, for that and for pulling together some of these questions. We've been recording this webinar, so we have a record of all this stuff. And I think that we will try and get back to some people if there are specific questions, but we'll also take the questions in the chat into account as we do further research going forward. It remains for me to say thank you to everybody who's taken part in this, all of the panelists, all the people who've signed up to listen in. These are critical times, and the fact that so many people have taken the time out to join us is encouraging for us all. And we've heard time and time again today that we've really got to think about this as an opportunity to plan, to reconvene. And I think too, it's an opportunity for us to think about further research that we may have to do in order to get our planning for the future just right. We're finding in some of the work I do in other places, we're finding we're having to run our scenario planning over and over again, using the most up-to-date facts and figures that we can obtain as we get deeper into lockdown, or as we get deeper into the easing of lockdown. So I've been asked to say what next steps we might take. I hope it's slightly a bit more research, and I hope it's more of this kind of meeting in which we can share our hopes, our fears, our concerns, and that we can actually turn some of the things that we've talked about as opportunities into realities. I've asked, just to close out our meeting, once again, thanks to everybody for being here, and for particularly, I think, for the convening power of Carnegie to put all of this together. I hope there will be more of it. But I've asked Michael Sheen, who came in to our discussion right at the beginning, to give us a couple of words of inspiration as we close out, and as we say thanks again for attending. Michael, over to you.
Thanks, John. It's been amazing to hear what everyone's been saying, all the panelists, so thank you very much. What I'm hearing is an openness to face up to the challenges. Clearly, this is not just a little blip. This is not just a little downturn. This is a major event that is affecting everyone. But this is the moment. This is what you're all here for. This is what you set your organizations up for. This is why you go into work every day. This is the moment to step up. And for all the challenges, I keep hearing as well people saying that it's an opportunity. And so I would just stress, and this is to myself as well, to hold on to the sense of mission that you have, to hold on to the reason why you do this in the first place. And with that secure base to stand on, then look at how you can adapt. How can you innovate? How can you meet the changing landscape that is ahead of us? Your experience will tell you the certain challenges that are coming along, but there are going to be other ones that you cannot possibly know at this moment. And so it's going to be, the readiness is all, as Hamlet said. I know that if you hold on to that sense of mission, that reason why you're here, to meet the needs of the people and the communities that you are committed to, and are open to deepening that relationship. I know that the rebuilding that is going to happen has to start from a sense of connection to those people. So deepening that relationship, deepening that understanding, and being responsive to those needs. If you can hold on to that sense of mission and be open to adapting, then I think this really is an opportunity and the moment for us in this sector, the people who work in this area, to show the value of this work. The need is going to be greater than ever. And so you are the people who are ready to meet that challenge. And I pledge myself to do whatever I can to help you in that way as well, and support. So thank you for letting me be a part of this today. Good luck to everybody.
Thank you, Michael, and thank you, everybody. Goodbye until the next time.
Thanks all. Bye-bye.